Good day to all, my name is Chloe, a senior research analyst from IFAS. The Israel-Hamas war, which erupted on 7 October this year, has sent shockwaves across the world. Oil prices rose shortly after the news of this war, but later declined as the war currently appears to remain contained so far. In this video, we explore the potential ramifications of the developments in the Middle East and their impact on the global economy. A main concern is the potential for the current situation to possibly escalate to a broader regional conflict. One key concern arises from the potential involvement of Iran in the Israel-Hamas war. Iran's foreign minister has already called for a full and immediate boycott of Israel by Muslim countries, including an oil embargo on the country. These comments have marked a verbal escalation over the war between Israel and Hamas. If Iran were to more actively participate, it could intensify pressure on the United States and its allies to enforce stricter sanctions on Iranian oil. This in turn would disrupt energy supplies and lead to higher oil prices, especially as Iran has become a growing source of extra crude this year, elevating an otherwise tightening market. US sanctions, however, is not the worst-case scenario. The worst-case scenario would see the flow of oil to global markets being interrupted, probably by the closure of the Strait of Hormuz. The strategic importance of the Strait of Hormuz amplifies these concerns. This narrow waterway facilitates the passage of nearly 20% of the world's daily oil supply. Any disruption in this critical choke point could send shockwaves through the energy markets and pose a global threat. It underscores the need for a delicate and balanced approach to resolving conflicts in the region. The current situation remains very fluid, and its ultimate impact hinges on how the conflict unfolds. Given the numerous uncertainties, volatility in oil prices is expected to remain high in the near term. And these developments also come at a time when global energy markets are already on edge due to supply cuts. Moreover, higher oil prices amid such conflicts has inspired fresh fears, as it flies in the face of efforts to tame inflation. There's a possibility that we might see inflation spike higher in the future as soon as the high base effects of energy prices witnessed in 2022 starts to wear off. Over the longer term, constraints on production from the private sector coming from years of underinvestment would likely mean that oil prices will likely remain higher for longer. This forms a strong fundamental backdrop for oil prices, and in view of this, we also expect inflation to remain higher for longer. With oil prices likely to remain elevated, investors may wish to consider the BlackRock World Energy Fund or the BlackRock Natural Resources Growth and Income Fund to get exposure to energy companies, or if they would like a more diversified exposure to the commodity sector. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Timing will be sharing more about ESR Group. Over to you, Timing.
Hi, I'm Timing, Research Analyst at Global Fixed Income. ESR Group has demonstrated robust performance in the first half of 2023, boasting higher revenues, albeit with a dip in earnings attributed to reduced one-off gains and increased finance costs. While this might sound like a mixed bag, there are exciting developments on the horizon that paint a promising picture for the company's future. In the financial realm, ESR's revenue has surged, signaling a strong start to the year. However, the flip side of the coin reveals a decline in earnings. What's the story behind this apparent contradiction? It's a tale of two factors. On one hand, ESR experienced a reduction in one-off gains. These are the exceptional irregular profits outside of the company's core business activities. While they can provide a significant boost to the bottom line in a given period, they are, by their nature, inconsistent. Hence, their absence in the first half of 2023 can be seen as a contributing factor to the drop in earnings. On the other hand, finance costs have risen for ESR, which the uptick in this cost weighs significantly on ESR's profitability. The jump in finance costs was more than 50% as compared to a year ago, which reflects the overall rising interest rates environment that ESR was unfortunately not immune to. Nevertheless, the outlook for ESR remains remarkably optimistic. The company's strategic focus on new economy assets positions it well for continued success in the short to medium term. These assets associated with the fast-evolving and technology-driven sectors of the economy are poised to remain in high demand, which is already reflected by the high occupancy rates and positive rental reversion of such assets within ESR's portfolio. ESR's commitment to these growth areas promises to be a valuable asset in its pursuit of long-term success. In light of the broader economy landscape, we continue to hold our recommendation for the ESR K 5.1% paper maturing in 2025. This recommendation is based on the relatively short tenor of the investment, which aligns favorably with the backdrop of higher interest rates that is expected to persist for an extended period. A shorter tenor can offer greater flexibility and a quicker return of capital, a particularly attractive proposition in a rising rate environment. However, it's important to remain vigilant regarding non-core risks associated with the perpetuals, given the lack of a clear maturity date. In this case, the high interest rates and step-up margin built into these perpetuals should be examined carefully. While they can offer potential for high attractive returns, they also carry unique risks that needs to be considered. ESR's performance in the first half of 2023 may exhibit some nuances, but the overall trajectory is one of optimism and strategic foresight. With its commitment to new economy assets and a continued recommendation for select investments, ESR is well positioned to navigate the evolving landscape and seize the opportunities it presents. Stay tuned for what promises to be an exciting journey ahead. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.